What is up, everybody? Welcome back to another episode of Bitcoin and Markets. My name is Ansel Lindner. Hope you guys had a good weekend. It is Monday morning or Monday afternoon. Monday is the day I put out the Bitcoin fundamentals report. So we are going to go through that, discuss. I'll answer any questions or comments you guys have. Put them down in the comments down below. I'm live streaming on YouTube, Rumble, Twitter, and Telegram. I'll check comments everywhere. So hopefully you guys have some. Put them down below. Let's jump right into it now. Share my screen. Bitcoin and markets.com. That's where you find all my content. Actually, other than Forbes, I just started writing for Forbes. I have my first post out for them. And here is this. You guys can see, just go to Forbes Crypto and look for Ansel Lindner. I am a contributor there. I put it out on all my socials last week. But 3 concepts investors must know about Bitcoin's 4-year cycle. I appreciate you guys checking that out. Following the author, you can, repeat visits is good. Also sharing that with people. I'm trying to target certain audiences. So that's what we got for this. Okay, let's go back to bitcoinandmarkets.com. Fundamentals report number 305. Let's go into this. So, quick navigation for you guys. This is a longer, comprehensive newsletter. So if you want to skip to certain things, like just see what the price analysis is all about this week, you can jump to that section. Macro, mining, layer 2. I do have a few things to say on the layer 2 section down below, so we'll get into that. Also, if you want to support and just check it out, do 1 month and join the price forecast competition that we do every month. You can sign up for half off for your first month, and then it's only $5 a month. It's less than, latte at Starbucks. So I appreciate everyone that supports. It enables me to do this show. So there you go. Snapshot of Bitcoin. Weekly trend, 58K gang. Thought we slayed those guys, and now they are back in control. And right before I went live, price was 58,000 or just under 58,000 by like $10. So 58K gang is coming back. But I'm sure we will defeat them sooner rather than later. Media sentiment is very slow. Not much going on out there. There is some news like Trump and his Liberty DeFi thing. I'm not paying too much attention to that. I don't care about DeFi. It's all a bunch of false claims and hype and ways to steal your money. Now, I'm not saying that Trump is trying to steal money. I'm thinking everybody goes through the shitcoin phase. You find Bitcoin, then you learn about Bitcoin, you learn about blockchain. You're like, oh, this can definitely be used for something else, right? So how about we make a project? Who's out there doing cool things with blockchain? Oh, look at all this DeFi stuff. ICOs, DeFi, it's all fake promises. Once you get past that first hurdle of being in for about a year or two, you start realizing that, all Bitcoin is the innovation in this space. Everything else is an affinity scam that really doesn't work, but they say it's like Bitcoin. And so that gives it some credibility just because Bitcoin has credibility. But yeah, that's what I consider the Trump thing. It's just maybe they have advisors that are scammers. I don't think they're actually trying to scam people. They're just in the shitcoin phase. And when you're a billionaire in a shitcoin phase, you want to do different projects. So they will live and learn in this space as well. Network traffic is very low. We'll take a look at the mempool down below. Revenue for miners, very, very low. They're going through a tough time right now, kind of just hoping and praying that price goes up. Price has gone up over the last week, issue to issue, about $1,500 or 2.5%. It was higher, going into closing on Friday. We were up over 60,000. We'll take a look at the live price chart down in the price section. Market cap 1.14 trillion. We were talking in the Telegram pre-show. We hang out for 5 or 10 minutes over there in Telegram before we go live on the other platforms. And Bitcoin at $1.1 trillion market cap is still a very marginal investment, a very marginal player. There is this feeling, and many people do know that it is a big player in the future, but it's not going to get that big player status until pretty much after this next bull market. When we add, 5x, 10x to this market cap, then it will start being a major player out there and be talked about in the same breath as U.S. Treasuries, as safe haven assets, as gold as safe haven assets. It is a safe haven asset. It's the best safe haven asset, but the market doesn't quite agree yet. They need to be exposed to some number go up technology. Okay, Satoshis per dollar, 1727 at the time of writing. One Finny, that's 1/10,000th of a Bitcoin, is $5.79. Mining sector previous difficulty adjustment last week, 3.5% to a new all-time high difficulty, and hash rate hit an all-time high as well last week, despite struggling with low revenue. The next estimated adjustment is 9 days away, so plenty can happen. This can even turn positive. Especially if the price spikes, we're going to see this probably race all the way to positive. But right now, it's estimated to be a negative 5% adjustment next week. Mempool, 10 megabytes lower than last week, 112 megabytes. Fees for the next block at the time of writing was under 50 cents, 49 cents, or 6 sats per virtual byte. And if you guys are new finding this content, you probably aren't, but let's just say that a few of you are new to Bitcoin. We measure transactions in their weight. And so this is a fee per size of kilobyte of bytes. How many sats are you paying per byte of transaction? Because you can have all sorts of different things going on with the transaction. And so yeah, that's how we kind of measure fees. And right now the average is like 49 cents. If you want to get in the next block, if you want to wait for about an hour or more, you can pay only 32 cents. That's not a big deal right now with fees so low. But if you think about it, if fees are up at 20, 30, 40, 50 bucks, which we expect fees to get that high in the far future, 10, 20% waiting for the next 10, 20% of your fee, waiting for the next hour is going to be big savings for people. Okay, Lightning Network. This has been going down consistently, but this week we had a big jump in capacity by 2%, so up to 5193. Channels also were positive, 93 more channels, up to 48,558. So, it's not very common to get both of these positive. We usually, if we do see a positive thing here on Lightning Network, we'll see one. But both of them positive, and the capacity at 2% growth, that is pretty good. Probably the best movement we've seen in the Lightning Network capacity in several months. So that's good. Okay, let's move down to headlines now. Oh shit. All right, I'm back. We are dog sitting, a big ass dog, and neighbor kid rang the damn doorbell. So there you go. Sorry about that. Okay, where were we? Headlines. Let me check comments first. Yes, we are live. What's going on, everybody out there? Live stream on YouTube, Rumble, Twitter, and Telegram. Check out the check out the YouTube and the Rumble. Like, comment, subscribe over there. Appreciate everybody that does do that. All right. No other comments. So let's get into it. more on the headlines. So, biggest headline this last week, MicroStrategy buys another 11,800 Bitcoins. And I linked to the article here in the bullet point. Just reading from that article a little bit. The enterprise software maker, MicroStrategy, whose corporate strategy includes buying the Bitcoin, bought the tokens between August 8th and September 12th, according to U.S. Securities and Exchange Commission filing on Friday. It's the largest amount of Bitcoin purchased since the firm announced in February of 2021. It's snapped up 19,452. This is a bad sentence, guys. Come on. MicroStrategy now holds around 244,000 Bitcoin, valued at around, okay, so this is funny. This is a little pet peeve, I guess, or nuance that you can tell the author is not a Bitcoiner, okay, and that's fine, but there's this unspoken rule about how to capitalize or not capitalize Bitcoin. And that is, if you're talking about the protocol specifically, or the kind of general, I would say, industry, you would use the capital B. If you're talking about the token, the price, anything like that has to do with price and the token, that is a small b. So they just got it completely backwards here. 244,000 small b Bitcoin, valued at around 14 billion. That's around 1% of all the small b Bitcoin ever issued. BlackRock's iShares Bitcoin Trust is the world's largest Bitcoin fund at about 20 billion. MicroStrategy has acquired its tokens, its coins, at an aggregate purchase price of 9.45 billion. So that's an important number here. That means their basis is that, and it's not doubled, but it's up about, what would that be, 60-70%. That's pretty good since 2021. And an average purchase price of 68,000 according to the filing. All right. So that is MicroStrategy buying up more and more Bitcoin. I also, when I first read this article, or I saw some, no, it was when I saw some digital art with Michael Saylor in it this morning. I was like, man, he has no kids. He has no legacy other than his business, I guess. I don't know his personal life, but he doesn't have a family to hand this down to. What's he going to do with the Bitcoin? And then I read another tweet maybe 2 hours later where he said, it's automatically goes into a trust or a charity of some sort, and it will be specifically for Bitcoin's future to, help with Bitcoin in the future and all this stuff. So at least they have a plan for that. But MicroStrategy holds a very, very significant amount of Bitcoin. And it's always kind of an uneasy feeling when one entity starts getting this much Bitcoin. I remember when Grayscale started getting this much Bitcoin, and they had about 3 times this many. I think they had 600,000 at one point at the peak. And that was interesting because, that is like a one-way function. It can never come out. Now, MicroStrategy could sell their Bitcoin if they wanted to. But Grayscale was legally could not sell their Bitcoin until they were changed into a spot ETF. Then that Bitcoin could come out. But the way that it was set up previously, it was a one-way function. It went in and it never came out. And that's one thing that did pump Bitcoin in the past. But okay, so that was that. Next headline is UK introduces bill in Parliament to clarify Bitcoin's status. You can see here from gov.uk, new bill introduced in Parliament to clarify Bitcoin's legal status. Tech-savvy Bitcoin owners of Bitcoin and other digital assets will benefit from greater legal protections thanks to an important clarification to the law. Now, I say I don't know much about what's going on here. I didn't research it in depth, really. But I don't have any confidence. I do not have any confidence that this will pass. We have a long way to go in Europe for Bitcoin to be seen somewhat positively. But to my knowledge, we haven't seen a single major political figure in the EU or the UK specifically that has endorsed Bitcoin. Perhaps Farage, but I'm not sure about that. So, however, this could be seen as a sign of the most negative positions against Bitcoin slowly coming to an end. So, this could be seen as like a bottom in the sentiment over there, or a bottom in the depth of what they'll do to Bitcoiners, how they'll try to take on Bitcoin. Maybe that is bottoming and starting to turn around. That would be a good sign for our European brothers and sisters over there. But yeah, right now I have no confidence in this particular bill. Okay, Ethereum breaks into the 0.03 BTC handle. Nothing is going right for altcoins, and Ethereum is the kind affinity scam on Bitcoin. What do I mean there? Ethereum is an affinity scam on Bitcoin. It's becoming more popular to dog on Ethereum, but some of us have been here since the beginning. I saw a ton of posts about Ethereum breaking the 0.04 level, and it's becoming popular to say altcoins are not going to have their cycle. Altcoins are not going to. There's not going to be an altcoin season again. But I've been saying it for a long time, and I linked to an article here. Altcoins are one big affinity scam on Bitcoin. A year ago, I predicted a 0.03 BTC handle for ETH. So you can see in this chart, I have not moved this arrow since about this time last year, maybe August or July of last year. This is what I expected, and it was following this path until just recently. And let me make sure I'm not muted on Telegram or anywhere. Had a sinking feeling. No, I'm good. Okay. So I expected to get down to this 0.03 handle earlier this year, but you can see the delay that the ETFs caused, some hopium, and then followed up by a sell-off. With the ETF, I'm more bearish than without the ETFs, because there is no ability to stake in the ETFs, and there is some value to staking Ethereum, at least measured in Ethereum, and that is not possible with the ETFs. So the Grayscale Ethereum ETF is just continuing to lose coins over and over, just like Bitcoin's Grayscale ETF lost a bunch of Bitcoin, continues to lose Bitcoin, but there's more demand from the others to make up for the demand of dumping from Grayscale. That is not present in Ethereum, and I said it wasn't going to be present in Ethereum because they can't stake. So the addition of the ETFs makes me more bearish on Ethereum. Just it delayed it a little bit from my year ago prediction. Also, you can see I said that when the fee burning started, you can't see my thing. When the fee burning started, that's when I said that was the beginning of the end for Ethereum, because as an economist, I was like, Ethereum's ecosystem, which is, it's a Ponzi with Ponzi's built on top of it. And what is required for that is this very high level inflation that Ethereum had on its base level. They thought, we're not competing against Bitcoin as sound money. We are oil, right? And so oil needs to have continuous flow, high flow. And then all of a sudden they stopped that. They started burning their fees and they went into deflation. And I said, this is going to be very, very bad for the Ethereum ecosystem, because all of these Ponzi's relied on this base level of inflation for Ethereum. Take that away, there's no money coming in that is going to be pumping this up. And that's exactly what we saw through the merge, through all the POS stuff, even through the Ethereum ETF. Price just cannot be sustained. So it keeps heading downward, and it will until they switch. They need to switch to maximum viable issuance instead of minimum viable issuance. That's just the way it's going to be. Ponzi's on top of Ponzi's need some source of inflation to keep the game going. Maybe we're at the end of the Ponzi. I don't know. All right. This also has implications for this cycle of Bitcoin. In previous cycles, altcoins stole some attention from the true innovation here, which is Bitcoin. Yes, some of those ill-gotten gains found their way into Bitcoin. For example, Block One has a ton of Bitcoin still. I think they have 160,000 Bitcoins that they raised in their ICO, which is absolutely insane. That tells you how insane that altcoin fever got. But much of it was simply funneled to its founders, VCs, and whales' pockets. This time could be different, and nearly all of the inflow will be directed toward the king, Bitcoin. All right, so that's all I have for Bitcoin headlines this week. Let's go into some macro headlines, but let me check comments if there are any. Guys, if you are watching over there on Twitter, you can comment on Twitter. I think there is a way to do that, but it's easier if you jump over to YouTube or Rumble. Those links should be in my pinned tweet. All right. Stand by 1 second. All right, sorry about that interruption. Had to tell my boy to stop jumping, making noise. I couldn't think. All right, let's get into the macro headlines. And here we go. So, Federal Reserve rate cut this week. Readers will know the Federal Reserve doesn't really do anything mechanically in the market. Maybe if you're new to my content, you don't understand that. But the Fed is expectation manager. They're psychological operator. They're not mechanically doing anything. And it doesn't really matter if they do 50 or 25 basis points or 75 basis points from a mechanical perspective. It does from a psychological perspective. But yeah, so that's what you need to how you need to kind of see what's going on with the Fed. When predicting what they will do, we should not consider their actions in regard to causing specific monetary effects. Instead, we should think of their policy as acknowledging economic circumstances as they currently are and how they are trying to influence the psychology of the market. So, slightly different way to see this, that it's not mechanical monetary policy. It is acknowledging that we're in dire circumstances and trying to influence the psychology of the market. Okay. The odds of a rate cut are 100%. The only question is how much. This morning. The market was pricing in 57% chance of 50 basis points. I think that they probably should add the chance of 75 basis points because that's probably rising at least to 5% chance of a 75 basis point cut. I saw that Elizabeth Warren and I think other senators signed on here as well to her letter saying to Powell, saying that they need to cut by 75 basis points. Interesting timing right before the meeting. There is a blackout period. I don't even know if they can get that letter before this. They definitely can't consider it or write back or do anything like that because they have a blackout period. I think it's 2 weeks before the meeting that they're not allowed to talk to press. They're not allowed to speak about monetary policy and all of that stuff. So interesting timing, though, by Elizabeth Warren, enemy of Bitcoin, by the way. All right, so CME, there you go. I'm still on the 50 basis point train, and I have been for weeks. In the dot-com bubble recession, they cut by 50 first. In the GFC, they cut by 50 first. The only difference was Powell's first round of cutting, which he cut by 25 basis points. And if you go back a year or more in me talking about this, I said he's probably going to cut early by 25 basis points because of his MO of 2019. But that didn't happen. He played the whole same game as every other Fed chairman over the last 20, 30 years. They wait too long and then they have to play catch up because they're not actually mechanically doing anything in the market. They just had to follow yields wherever they go. And if yields start opening up this huge gap, look at this, a 2-year and the Fed funds range is 169 basis points. If they do a 50 basis point cut, it just takes them to this little spot right here. This is nothing. They got so much further to go. That's why I think there's actually a chance that 75 basis point cut letter might be onto something. Maybe they'll cut by 75 basis points. If anything, they'll cut by 50, and then the next meeting they'll cut by another 50 or maybe 75. But this 170 bips is not going to get smaller. I mean, maybe, yeah, obviously with random volatility, we could see the yields move up slightly. But the recessionary levels, which we're going into recession, are lower. And so this spread of 169 bips on this chart is going to get bigger. And the Fed is going to have to follow it down, especially if we get some sort of crisis or a building crisis. They're going to follow rapidly downward. All right. What else do I say? A few headlines about banking stocks having a bad couple of days last week, but there are still no major signs of imminent banking stress as we approach the end of Q3. You guys know I'm big on seasonality. End of Q3, very important. End of Q1, very important. We are approaching this end of Q3, and there is no real imminent banking stress. So that kind of tells you what to expect here. It seems markets might have some runway left prior to recession, but I will be watching and reporting on this going forward. Okay, so that's what I am thinking going into the Fed funds or the FOMC monetary policy announcement. I will be covering that probably live, at least the statement drop. I might not be watching the press conference live, but I love when I get the chance to do that. But anyway, make sure you like, comment, subscribe so you can get notified of that. Okay, things are getting bad in China. China overnight economic data. Unemployment rate, miss. Retail sales, miss. Industrial production, miss. Fixed asset investment, miss. China's economy is in awful shape. And you can see just red all the way down. Now, people might get tired of me talking about China, but the reason why I do it so regularly is for a very important reason. Most people's vision of China is dead wrong based on a faulty assumption of the direction of the global economy. So the way you view China kind of tells me how you view the future. If you think China is bound to be a U.S. rival, is bound to overtake the United States, is bound to continue to grow even, you're most likely like AI. Most likely you think AI is going to be something great, very, very important. You think we are going to be a multi-planetary species anytime in the next 1,000 years. You think in some sort of linear growth, linear progress. But that's not how the world works, because China is not going to be surviving much longer. The CCP China is not going to be surviving much longer. And so that, you have to wrap your head around that, then to start questioning these other things. You have to question linear growth. You have to question AI. You have to question all these other things, and then bring in an understanding of demographics, bring in an understanding of a declining credit bubble, global credit bubble, and all of those things. Then you can start getting, I think, a more accurate representation of what the next couple decades are going to be like. So anyway, China in its current form is not bound to be a significant rival of the US. It will be a victim of deglobalization and communist collapse. So, this was a chart from this week floating around on Twitter from the Financial Times. You can see RMB denominated, dollar denominated funds for VC fundraising in China just falling off a cliff here over the last couple of years, down to virtually nothing. Dollar denominated, virtually nothing. RMB denominated, maybe, you know, 5 billion worth of RMB denominated funds. So, not much. Companies founded, also, you can see peaked out around 51,000 back in 2018, and it has been way down now. Pretty much, again, virtually no companies founded in China in 2024 so far. This is nasty. Very, very nasty. Not a good look for China. Okay, then we chart this is the Shanghai Composite Index hitting 5-year lows going back here to 2019. But then, if you go back in front of this low, you're going all the way back to 2015, 2014, when the stock market was this low. So it's like a lost decade almost for these Chinese stocks here. And it's continuing to go lower. Don't forget, China's outlawed short selling. They've taken many steps towards keeping the stock market from falling. I think they have something with margin accounts, or I don't know. They introduced some other rule into their financial system over there in China, and it's supposed to keep people from selling stocks, basically, and it continues to sell off. So that tells you, there's so much negativity economically in China right now that it's able to break through even these measures that are put in place to protect the value of the stock market. Okay. And this last one here, China detains investment bankers, takes passports in corruption sweep. So just cracking down. This speaks to kind of the Marxist-Leninist thing. We don't know how a Marxist-Leninist crackdown will look because we haven't really seen one in 50 years. With the new technology, with the internet, with the markets, the way that they operate today. But by watching China, this is going to be a model of how the kind of modern Marxist-Leninist revolution happens, because Xi is going back to hardcore Maoism. Get ready. The Great Leap Forward 2.0 is coming up. All right. So that was it for headlines. Let me check the comments before we go on. No comments, guys. Put your comments down below if you have anything, questions, comments, concerns. Let me check Telegram. Okay, Boog asks, with a going into recession probability up, would you consider this a soft landing? I don't think a soft landing is likely. But there is a chance that we do see, at least in the United States, maybe in some other Western economies, probably less so in like Germany and Italy and Spain, the worst demographics areas, I would be more bearish. But there is a chance that we get a deep but brief recession. And what I mean by that, or the way that would happen, is that, rates crash, we go into recession, there's mass layoffs. But what else crashes with rates? Mortgage rates. And there's a lot of pent-up demand for refinancing homes that were bought during the last few years with very high interest rates. There's a lot of pent-up demand for buying homes. And so as the interest rates, mortgage rates fall, there's going to, your payments fall. So, for example, let's say you have some house, you have a budget. Sorry, you have a budget for a mortgage that you can afford. Well, when with rates at 6% versus 2%, I mean, you're paying like 2.5 times on your monthly payment. So you can't afford that. But as soon as the monthly payment drops in half because the interest rate drops in half, then you can afford that. And then you'll go out and buy a house. Now, did that do? Um, that's lending, that's credit expansion, refinancing. Money will be um, saved on a monthly basis, put back out there for disposable income. Maybe you take some equity out of your house at lower rates, and then that goes right into the economy. So there is a route to, like I would say, like private sector stimulus as rates fall. That's possible. So brief or deep, but brief in the United States, but places with worse demographics, Japan, China, South Korea, Germany, Italy, Spain, those places will not be able to bounce back. See, that's going to be one of the big differences coming up in the next 10 years is that they will not have the ability to bounce back. So the US might recover from this next recession, but China won't because their demographics are garbage. So that's how I'd answer that. Okay. Let's jump into price analysis. Of course, I have my Pro. I'm not calling them protons anymore. I called them protons because I was writing for Bitcoin Magazine Pro, and I didn't want to be too like with them, so I changed it to protons. But you can get my professional tier, which is premium content for price. Just go to the sign up today, right there. Bitcoin charts. Last week we were bouncing off support. During the week, we attacked the 50-day, broke it, but are currently selling off again. On my Friday live stream, I said to expect a slow weekend, followed by the first half of the week being slow due to the FOMC anticipation. And you can see the support found on this is the 50-week and the 365-day and the 50-day. Here, we did close above it twice and then fell through it yesterday, and today it was negative at the time of writing. But let's take a look at the live chart. If I can come in here, and you will see this. Let me take these off. You'll see that chart later. 57,758. That's almost exactly what it was for the actual newsletter. Let me see. Going back here. 57,755. Holy cow, $3 off for this snapshot versus what the actual price is right now. So yeah, it's just kind of meandering around slow right now prior to the FOMC. That's what we're kind of waiting on. Everyone's waiting on that. We are still on track for October's typical rally to occur a week or two earlier in September due to an early halving. We talked about this. Uptember is a possibility. And right now we're not seeing that. I mean, I think September, let's see, where did September open? We've talked about this before, but let me just go to a monthly chart. And we are red still, but it opened at 58,967, which we were above. Now we're back down below. September probably will end positive, and Q3 then I think needs to get to 62,000 to be positive. But that's possible, very, very possible as well. Okay. Bollinger Bands, they're not an indicator that I watch regularly. However, it does use the 20-period moving average as its center line. And people do watch the 20-period moving average. As you can see, the center line is downward sloping. And the last time we had a similar setup was right before the post ETF rally. So what I'm talking about is a slope of the line, the center line. You can see we have a negative slope, and we're testing the negatively sloped center line. This was a positively sloped center line that we were testing here. positively sloped here, negatively sloped, but we're testing it from the downside, not the top side. I guess you could say, no, that one's positively sloped. This one is ever so slightly positively sloped, but not really. It's or negatively sloped. It's pretty much flat. So you have to go all the way back to here to get a negative slope and a test. And then what happened? Boom, ETF rocket ship. So that's what I wanted to show you guys there. The bull flag is massive. The measured move of it is equal to the flagpole. So when you're looking at flags, you take a look at the pole leading in, and that's should be the same size leading out. And that takes us up to 150K, which I don't think will be super easy to get to, especially rapidly, but you can see how long this takes. So this took all the way here, and this one could take all the way out to March, February or March on that measured move. There's not much else to say about price. The first half of this week, FOMC and rate cut is sucking all available mindshare. There are tons of charts circulating on X about M2 money supply and Fed rate cuts being positive for the Bitcoin price. Here are just a couple. So this one was from Crypto Rover that I snagged. And he's saying, you can see this kind of yellowish line is the rate cuts. And when we cut big in COVID, that was very positive for the price. However, just note on this chart, these cuts earlier in 2019, those were Powell's first rate cuts. He did 3 25 basis point cuts in 2019. No real reaction. I guess you could say there was this little reaction, but that was kind of before he started cutting. So which comes first, the chicken or the egg here on this diagram? But yeah, if we start coming down, perhaps that's the next leg up. But it would also be like, see this kind of topped right as they started cutting. So maybe that's signifying that we're going to have more. We're going to have another 9 months of consolidation here. I can't believe it, but that's what that chart is kind of saying. Global liquidity. This is M2 of all of these different central banks by the rational root. Fed, ECB, PBOC, BOJ, England. So we got a bunch here coming down, and this is the consolidated M2. As M2 goes up, we see the price of Bitcoin going up. A lot of people say this is inflationary. This is like a measure of money printing, but it isn't. It is not a measure of money printing. It is actually the opposite to a degree. So what it is, and I say, in my opinion, this is correlation and not causation. So M2 specifically. M2 money supply grows when shadow banking liquidity and esoteric forms of money supply shrinks. So in good times, the shadow banking system will be pumping out credit. Lots and lots of credit. That's actual money printing. But in bad times, they're not going to be doing that. And they rely on either fiscal spending or Fed QE. And that transforms things from the shadow banking sector into M2, into stuff that we can see. It brings it out of the shadows, but that's not good because it's low powered money. Money that's in the shadow banking system, especially when the shadow banking system is working well, is high powered money. If you take it to M2, that's low powered money. So this is really a measure of dysfunction. As M2 is going higher, this is a measure of dysfunction in the shadow banking system. I mean, there are some very good correlations here, but I don't see it as causation. Bitcoin is an alternative asset without counterparty risk. Also grows during these periods. I'll be writing more about this in the next Bitcoin Minute. So I put out these other pieces, macro and Bitcoin minutes, free on the website. So sign up for the email list to make sure you're notified of those. Overall, this is for price. Overall, fundamentals are still very solid, Macro factors continue to align with recession, creating a quite favorable environment for Bitcoin. Most gains happen in very short periods of time. For example, if you check out the chart above with the bull flag, nearly all gains this year came in February alone. So let's go back up here. You can see 2024 starts right here, right before the ETF launch. But most of the gains came in February. This just these few weeks of the entire year. So they can happen. It can happen very, very fast. Most gains happen in a short period of time. FundStrat's Tom Lee has previously said Bitcoin sees its biggest gains in just 10 days each year. So if you're not hodling long term, you're probably going to miss out on most of these 10 days and miss out on most of the gains from Bitcoin. So very important statement there. This week should be slow into the FOMC, but with the potential to rally in the second half. So that's what I have for price. Before we go on to the mining sector, let's take a look at any comments. Really hoping we get some comments here, guys. So put them down there on YouTube and Rumble. I think there's a way to do it on Twitter as well, but don't know if it comes across as easily into my back end of my streaming platform. Okay. So let's go on to the mining sector. Headlines: Bitcoin mine shutdown in Norway sparks higher power bills for residents. So quoting from this Bitcoinist article, after a Bitcoin mine closed in Hadsel, Norway, residents received a surprise. Initially lauded for decreasing noise pollution, this shutdown has raised community electricity prices. Oh boy. Careful for what you wish for. Operating under Crypto Vault, the mine consumed a significant portion of the local power distributor Noranet's income. Now it's closing. Locals are dealing with a 20% rise in their electrical bills. Residents had complained for years about the continuous noise, the cooling systems of the Bitcoin mining operations. Mayor Bjorg Freiberg said that the noise had bothered a lot of the roughly 8,000 residents of the town. For those against the mine, closing seemed like a victory, but it has had unexpected financial consequences. The neighboring power company was obliged to raise rates in order to offset the lost income from CryptoVault's operations. The network manager, Robin Jacobson, claimed that losing such a large customer has seriously damaged their income. So what happens when they do this? I mean, it's so funny. You have these anti-Bitcoin zealots out there attacking this, and then they get what they ask for, higher prices. What happens if the power company actually goes out of business? What if they have to raise them another 20% or something? Not good. It's not good for anybody. Bitcoin helps the environment. Bitcoin helps with lower energy costs. But this is what degrowth looks like. Marxists trying to put in their climate agendas. You have Bitcoin derangement syndrome, and you go after Bitcoin mining, and your costs just go up. All right. So hopefully they learn. Bhutan, next headline: Bhutan's Bitcoin holdings revealed. Kingdom owns 780 million in BTC for mining, and that is very significant considering it's a very small country with a small GDP, relatively small population. But you can see Arkham here. They have put out the actual address with how many BTC they have, 13,000. Pretty big numbers for such a small country. And I do link to this article from Bitcoin Magazine here in the bullet point. Reading from that article, South Asian country Bhutan, a Buddhist kingdom in the Himalayas' eastern edge, has been revealed as a major Bitcoin holder, owning 13,000 BTC, worth around 780 million, according to report on Arkham. The public data company identified Bhutan's Bitcoin addresses, marking the first time this information has been publicly shared. Bhutan, quote, Bhutan is the fourth largest government with Bitcoin holdings on our platform, with over 750 million BTC. Fourth largest, this little tiny country, poor Himalayan country, is the fourth largest government holder. Come on, guys. First mover advantage. If you're Germany, if you're Italy, if you're the UK, if you're Brazil, if you're Argentina, for crying out loud, you have to get on the program here. Little Bhutan is taking you over. Little El Salvador is taking you over. Are you going to let them make a fool of you? Continuing, quote, unlike most governments, Bhutan's BTC does not come from law enforcement asset seizures, but from Bitcoin mining operations, which have ramped up dramatically since early 2023. And there's companies in there helping them to boost their mining. And yeah, so that's great. Not from law enforcement seizures. That's where all the US's holdings come from. That's where, I guess that would be where all of China's holdings come from. They're not out there buying on the open market. That's not where El Salvador's Bitcoin comes from. They mine as well, but they also just buy. So don't lump every single country into that. It's just the US and China on the top of the list there that have gotten it from law enforcement asset seizures. Okay, so that is, I think, a feel-good story. I really think both of these stories are kind of feel-good stories. We have these anti-Bitcoin zealots getting screwed, self-own there, and then we have Bhutan doing some good quality proof of work and mining their Bitcoin, becoming the fourth largest government to hold Bitcoin. Okay, next part up here is hash rate and difficulty. The difficulty jumped the last 2 weeks to a new all-time high. Hash rate promptly fell off after that. Hash rate is down only slightly on the 7-day moving average. So you can see this brighter line is the 7-day moving average. It's only slightly down, but there's been some volatility in the hash rate after that big difficulty adjustment, this pink line, up to a new all-time high. Nothing really significant about this, but other than it being an all-time high, and yeah, just despite the price, Bitcoin mining and Bitcoin hash rate and difficulty continue to go higher. All right, mempool. Bitcoin's mempool, those are transactions waiting to be confirmed by miners, lost several more megabytes this week, down to 112 megabytes. Could be a good thing or a bad thing, depending on how you see it. Most of the remaining transactions are very cheap at I didn't mean 1.2, I meant 1 to 2 sats per virtual byte. Okay, let's take a look at this. You see this pink down at the bottom is the main amount of transactions at 1 to 2 sats per virtual byte. This purple next up is purple, and it's 3 to 4. So pretty cheap transactions out there. Of course, these aren't all the transactions that get confirmed, right? The transactions that are coming in on a constant basis will get confirmed. That's why this isn't really declining all that much, because the inflow is matching the confirmation number. So there's, I don't know how many transactions today per day. Let's say 10,000 transactions per day can be confirmed. There's about 10,000 transactions per day that are made, and they're getting confirmed, not leaving any room for these cheaper transactions to actually come off. Just about 10 megabytes a week. So there you go. That's the update for the mempool. All right, layer 2, then check comments, and then we're out for the day. So build on Bitcoin trend imports another concept from Ethereum, the DAO. And I link to this article here. Can't remember now. I think it's from CoinDesk. So it's archived. But okay, DAOs are an old idea at this point in Bitcoin's history. Decentralized autonomous organizations are complete doublespeak. Decentralized. They are not decentralized, normally because insiders and founders have either controlling keys or controlling share of pre-mine. Those are coins distributed before the public had a chance to buy. These things are not present in Bitcoin, obviously. Autonomous. They are autonomous only to the extent that they've been tested in a very simulated environment under perfect conditions. One of the laws of programming, I just kind of made that up, but there probably is something like that. One of the laws of programming is there will always be bugs. If this DAO runs into a bug, it ceases to work and your investment will crash to zero, unless there is a centralized group with override keys to go in and fix things. Also, these DAOs always want to upgrade. Well, how exactly does that happen against the game theory? So, decentralized things that are truly decentralized in a decentralized network do not hard fork. Uh, that's the game theory behind it. If you have a network that hard forks and hard forks relatively easily, it's because it's centralized. Decentralized networks cannot hard fork. Okay, the decentralized network with a token, the game theory will protect the value of the token as it is, creating a Nash equilibrium around against hard forks. So if we're going on this consensus, block after block after block under these certain rules, and somebody wants to change the rules, there's always built-in risk around changing the rules. Maybe there's going to be a consensus failure. Maybe there's going to be a bug that we didn't see. Maybe people don't like it. Maybe it's not popular. So there will not be a hard fork. The game theory goes around the Nash equilibrium against hard forks. Okay, if there is a hard fork, what is stopping existing nodes from running both? See, you will always run both. Then you can have two tokens that are non-fungible with each other, right? And that original chain will continue to function and most likely get the lion's share of the market cap. Why hold a token that can infinitely fork and dilute your investment to zero? Moreover, each fork introduces yet more risk of a bug. Overall, DAOs are scams that are technically impossible as of right now and likely into the far, far future. The technical hurdles are so large and the return on fraud so high, you can be certain that every DAO attempt is a total scam. So let me read that one more time because you probably start seeing this in Bitcoin. Going to see talk about these tried and true scams that are from Ethereum coming onto Bitcoin. And I'm just trying to get you guys prepared what you're going to hear here. So the technical hurdles are so large and the return on fraud so high. You can be certain that every DAO attempt is a total scam that you're going to run across. People who believe in DAOs are either ignorant or in on the scam. All right, so next topic of layer twos, Fractal Bitcoin set to launch sidechain with unique merge mining mechanism. Now, disclaimer, I am a sidechain proponent. I think peg sidechains are the way to go in the future, kind of like Elements. Liquid is the main Element sidechain right now. I can see most jurisdictions, most countries running their own pegged Bitcoin sidechain. So they can have all their different rules that they want on their sidechain and cryptographically pegged to Bitcoin so they cannot devalue their currency unless they want to, unless that is, whoever's in charge of updating the rules to the sidechain could change that. But at least you would be able to see that. Okay, so Cadence Mining plays who am I linking to? Okay, I think this is bitcoin.com, who I also do not link to directly. So this is archive link. Cadence Mining plays a pivotal role in fractal Bitcoin's design. Unlike the usual merge mining, where miners safeguard two blockchains at once, this method spaces out block rewards, enabling Bitcoin miners to mine fractal Bitcoin blocks every third block. So basically, merge mining is when the Bitcoin miners can work on both of the problems simultaneously. And a Bitcoin block is like confirming the sidechain block as well. So that's why it's called merge mining. The problem with merge mining is it introduces new incentives. Okay, this is a very old idea. One of the most famous attempts, or I guess long-running attempts, is drive chains by Paul Stortz, and he thinks that drive chains are the way to go. They're merge mined. That he thinks that the incentive, the way that it messes with the incentives, is not all that important. I tend to disagree with that. But this is a new design, a new layer 2 that is trying to use merge mining. So not really too exciting, but we're starting to see some of these what is old is new again out there. I'm just trying to bring these up to your attention. So the approach offers a distinct take on how mining rewards are distributed. That is not good. You don't want to mess with Bitcoin's incentives, all while aiming to ensure the security of the main Bitcoin network remains intact. Okay, I don't care what your aim is. If you're messing with mining rewards, you're messing with the incentives, your aim is naive. All while aiming to ensure the security of the main Bitcoin network. Nobody cares about your naive aim. It's not going to work. If it catches on, it's going to destroy the incentives of Bitcoin, because you're just a fallible human that has no business trying to take on nature, which Bitcoin is part of nature. It's an element on the periodic table, should be Bitcoin. You're trying to mess with this nature of Bitcoin and mess with the incentives, the natural incentives. And guess what happens to all central planners? They mess it up. They fail. No one cares what your aims are. You're going to fail, just like every other central planner. In the past, merge mining projects raised concerns about diluted hash power and weaker commitment to Bitcoin, basically messing with the incentives. Fractal Bitcoin aims to be a distinct sidechain, complete with its own native token. Again, its own native token. Red flag, red flag, red flag, red flag. No. Anything that introduces its own native token is by definition a scam. Liquid Bitcoin is not, because it's cryptographically pegged to Bitcoin 1-to-1. So it's not its own token. It's just a derivative of Bitcoin on a sidechain under different rules, but it's cryptographically supply pegged to Bitcoin. So it's not really, I guess it is a native token kind of, but it's does not have its own monetary unit. The monetary unit is Bitcoin for Liquid. Now, this doesn't sound like that's going to be like that. It has its own native token. Big red flag. Out of the 210 million total tokens, half are set aside for miners. Okay, only half, in order to keep the network security strong. Well, that's your aim, but that's not going to happen. The ecosystem treasury claims 15%. The ecosystem treasury, so that's really the founders, secret back pocket that they're putting all this in. That's going to claim 15%, while another 10% is earmarked for community grants. Again, we've heard all this kind of talk before. Oh my God, it doesn't work. Okay, this is like feel good stuff. Community grants. It's I don't know. It just feels so 2016, doesn't it? It's all just naive. And who's going to get these grants? Probably the insiders that know how to work the system. Okay, intended to drive engagement. So they're going to try to farm engagement with this 10% of earmarked community grants. Interestingly, 5% of the tokens are allocated for pre-sale. We need to get some insiders hooked in here. With a lockup period in place, an attempt to maintain stability during the network's infancy. Okay, the bootstrapping problem is a big problem, and this goes back to some of my content that I did way early on. You try to come up with all of these things, but all you do is you screw with incentives. Okay, Bitcoin has pure, unadulterated, immalleable, immutable rules. These are like, we're just going to kind of pick some cool things that we think are going to work in a different package. And guess what? Every time you step away from the pureness of Bitcoin's incentives, the pureness of the entire architecture of Bitcoin, as soon as you step away, there's a trade off. There's a trade off for only doing half of this to miners. There's a trade off for having an ecosystem treasury, which is probably just the founders scamming you. 10% earmark for community grants. There's a trade off for this. There's a trade off for 5% for pre-sale. And those trade offs will create a situation. They pervert the incentives so much that you can never right the ship. You turn into a cluster of trade offs and incentives. And pretty soon you're going to introduce, to fix the complexity of your incentives, you're going to come up with a hard fork within a matter of probably 6 months. Oh crap, we gotta tidy this up. And what does that do? It just centralizes you more and messes with your incentives even more and hurts your value long term. This is exactly what all of these altcoins have gone through. ICOs went through, DeFi went through. There's trade-offs, and to fix the trade-offs that you think you can fix, you actually harm your overall value proposition, which is being decentralized. So it's just, all of this is coming to Bitcoin. It's very interesting because, all this was the altcoin side of the house. Now this is coming to Bitcoin. So we'll see if this does have some positive effects on the Bitcoin price. Right now, I don't see it because there's just not very much retail interest at all going into recession. People's wallets are very low. There's no discretionary income. There's no YOLO when you can't buy food. Okay. So that's why we're not having retail in there right now. But okay, that wraps up this stuff. Here's the stuff I wrote this last week, the premium, Forbes, and then my stuff on the website. Let's go back up to the top and I'll look and see if there's any comments. Dex Invictus says comment. Dex says, just got off the phone with Bitcoin CEO. He said, no grants, fam. Yeah. Every time you try to screw with Bitcoin's pure, unadulterated incentives that work, there's a trade-off and messes with the incentives. And then it has downstream effects that you have to come back and hard fork again. And that centralizes you and it has more downstream effects. So this is a bootstrapping problem. I detailed it out. Let's see if I can find it real quick. Okay, bootstrap, blah, 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 blah. I wrote it several years back. Let's see. Okay, not that. I think it was in my rules of thumb. Let's see. Okay. Let's share this tab. Sorry that took me so long. So this is blockchain rules of thumb. And you can see I wrote this back in 2016. It's a good read. Let's just go through these rules of thumb for Bitcoin. I know this live stream is getting a little bit long, but I'm going to wait and see if there's any other comments. coming in. If you guys are watching on Twitter, jump over there to YouTube and Rumble. Like, comment, subscribe. Appreciate that. Helps the channel grow. And it comes through very easily. I do see one comment coming through from Twitter, so you can make a comment over there. But yeah, let's read through these rules of thumb real quick. Rule number 1, it must be a real blockchain. I need to define blockchain first and then go from there. A blockchain is a public decentralized ledger. It's a very specific type of database for a decentralized network created from proof of work, digital tokens, and monetary policy. And I have a footnote. Interesting. I didn't remember doing that. Without exception, a blockchain must be made of these lower level variables. So it has to have proof of work, has to have a native token, and it has to have monetary policy. However, the specific values of the variables can be altered. For example, a monetary policy can result in limited supply like Bitcoin or constant inflation. Another example is using an ASIC resistant algorithm for proof of work that will limit the use of specialized mining equipment. I think Monero has that, right? There's some other supposedly ASIC resistant algorithms out there. As you can see, these variables can be tweaked, but it is highly unlikely that a stable blockchain will result if it doesn't include these three things, and Bitcoin's specific balance is evidently the best. Okay, rule number 2, blockchains provide consensus, not efficiency. Most blockchain projects fail because they don't understand a blockchain's role. If you hear people say that blockchains are more efficient than centralized solutions, it's likely a scam. It definitely is a scam. Okay. A lot has changed since 2016 when I wrote this. It definitely is a scam. In fact, trusted third parties are quite efficient. Let me read that again. Trusted third parties are quite efficient and arise naturally in the free market. Centralized databases are very good at what they do. Perhaps this mistaken decentralize all the things belief comes from the fact that decentralization can increase capacity, availability, and speed of networks. Companies like Netflix are actively studying how they can use peer to peer services to better serve their customers and ISPs' needs. I don't know if anything has come of this. I think they might have multiple, distributed architecture, not decentralized specifically, but distributed. But yeah, you can increase capacity if you aren't taxing one central node all the time. You're taxing multiple nodes, but it's still centralized under a company or under the rules of the network. Okay, so while decentralized networks are great for data sharing, they are horribly inefficient at consensus. All the strengths of decentralization are neutered when a network needs consensus. So again, all of the strengths, this would be capacity, availability, and speed. All the strengths of this decentralization are neutered when a network needs consensus, and it can't rely on a central party like a company. That is what centralized parties do on a financial network: provide a source of truth for the ledger. For a truly decentralized network to have consensus, it needs to give up a lot of its efficiency by duplicating all the things. So instead of decentralize all the things, it needs to duplicate all the things. Every node has to be a network in and of itself. Okay, complete decentralization is everything needs to be duplicated on every node. That is what we're talking about here. Only when central party corruption outweighs the cost of decentralized consensus is a blockchain workable. Currently, Money is the only app that meets this requirement and will likely be the only app since it's so powerful by itself. All right, there are two primary reasons for this inefficiency that I want to briefly discuss. Okay, blockchains require resources, hardware, software, computation, and energy consumption to be duplicated in every individual node. And two, maintaining a shared state on all nodes without a trusted third party is a delicate and costly matter. 2.1, duplicate all the things. Okay. Talk about this. Proof of work is expensive. Okay, number 3, blockchains have a high degree of immutability. One of the benefits of a blockchain is its permanence. History and your balances cannot be changed easily by an attacker or a trusted third party. If you hear a use case that supposedly doesn't require immutability, you must ask, why would it require a blockchain? It would be better served to use a traditional database that's designed to update records as opposed to an append-only ledger. The level of difficulty to change the past is synonymous with the blockchain's immutability. If history is easy to rewrite, there is little value in using a blockchain at all because miners won't waste effort producing it in the first place. Whatever the problem a mutable blockchain is solving, it can be done more efficiently with a centralized solution, as stated above. Users and miners will leave to join a network with higher levels of immutability. Okay, rule number 4. I think this is the one we're getting into, the incentives of the bootstrapping problem. There has to be a monetary incentive to participate in Bitcoin. Nodes don't automatically support your network because they think your project is awesome. People need to benefit directly from running your software. Promises only work for a short time, and die-hard early adopters will leave after a while if it's not paying off. They'll instead join a network that is currently growing and paying. Direct monetary reward through proof of work is absolutely necessary for miners to participate. Users without miners is a pointless situation. The running of a node must be made profitable in some way. Okay, blah, blah, blah. Project in a bootstrap phase, but that doesn't talk about it. Okay, this is it. Rule number 5. Launching a blockchain is extremely hard and perverse incentives. So this goes back to that layer 2 discussion about the fractal Bitcoin, messing with the incentives with merge mining and all that other stuff. So here we go. This is from my 2016 blockchain rules of thumb. Bitcoin was lucky. Satoshi launched in relative anonymity, and Bitcoin benefited from that incubation period. Importantly, the incentive structure of Bitcoin was able to take root and grow organically with very little interference from knowledgeable attackers. Today, the task of launching a coin is more difficult. A community of millions of users is watching. A vast number of speculators are just waiting to pump a new coin, only to dump a week later. There is no incubation period for the fledgling network like the one Bitcoin enjoyed. The problem with many of these schemes for launching a new coin is that they pervert the core incentives of the network. The problem with many of these schemes launching a new coin is that they pervert the core incentives of the network in an attempt to make it through the first several months intact. 5.1, the initial coin offering. We've seen the ICO become the premier way, again, this was back in 2016 when I wrote this, of tackling the difficult bootstrapping problem. Founders sell coins prior to the Genesis block, supposedly to align users' self-interest with the coin from the beginning. So they want to get your buy-in by these ICOs, and it kills two birds with one stone, funding the continued development of the project and establishing an initial distribution. But there's a catch. The incentives for the founders and developers get shifted from providing useful features to keeping the speculators happy. That's why those don't work. Courting speculators. New blockchain projects are launched right into the fire of sophisticated attackers and an educated community. And it's way more today than in 2016. Way more sophisticated, way deeper, different layers of scammers are pumping you. So not only is the team pumping, the founders, but the VCs, they have their own corral of scams that they're running. They're pumping you. And then there's the whales, or there's the influencers that are pumping. There's all sorts of different things. And these are all sophisticated attacks that can be used against Bitcoin. All right. Far from being considered a problem, speculators are courted by new projects because they impart value, which attracts miners to secure the network. It becomes an inescapable cycle. Speculators are attracted by flashy features. that developers can never hope to deliver on in a short period of time. Without these sky high promises, though, there'd be no speculators, no miners, no security, no hope. So the promises keep coming. A new project also faces the prospect of choosing their mining algorithm. Most will end up on an ASIC resistant algorithm, or else they will fall victim to a 51% attack right out of the gate. The only problem with this path of least resistance is that it's also very easy for miners to abandon the network in favor of the next hype coin. So, Bitcoin with SHA-256, all of these ASIC miners that are built for SHA-256, they're, um, algorithm specific integrated circuit. It cannot be used on any other coin. I mean, it could be if there was like Bitcoin Cash still uses SHA-256. I don't know. But if you build a ASIC resistant algorithm, I think that's what ETH had originally because they could use GPUs. They use GPUs. So, but the problem with using a GPU is that that GPU can be used for any coin. So you really don't have any buy-in from the miners, any sort of sunk cost that's keeping those miners on your network mining your coin. And so that's a big, big problem with choosing this path of least resistance. Okay. The only problem with this path is that it's easy for miners to abandon your network in favor of the next hype coin that comes along with yet more outrageous features. So you promised all these features. Now they're going to promise even more features, and you get into this feature war that really doesn't have any possibility of ever coming true, just to court speculators so you can court miners so you can court security. It's all just a shell game. Everywhere a new blockchain project turns, they are greeted with the harsh reality that perverts their incentives. Okay. Rule number 6, blockchains are government resistant, so companies cannot be responsible for them. Blockchains arise in a decentralized network, as I've stated. So blockchains are a product, they're an artifact of a decentralized network. It's not like a tool. It's a product. It's just data. They are currently in unregulated environment outside the control of any particular country. A truly decentralized network cannot be regulated in any traditional sense. Hence, blockchains are government resistant, often phrased as censorship resistant. Banks, by definition, are centralized and regulated. They are caught in a regulatory prison and preclude them from implementing a government resistant technology. Do they really think governments would allow a bank to create software that could undermine all their efforts to control the economy? That doesn't mean a bank cannot use a blockchain. Banks definitely can and will use Bitcoin's blockchain. It only means that a bank cannot be responsible for creating and maintaining a government resistant technology. So that is in like R3CEV, which was this company that tried to sell blockchain technology to banks. And I'm just pointing out why that's a dumb idea, because banks cannot be responsible for government resistant technology. If you read a claim about a bank creating a blockchain, you must ask how is it regulated? This also goes for CBDCs, right? They cannot. There's no reason for a CBDC for a blockchain or any sort of distributed ledger or anything like that, because it's government resistant technology and they wouldn't be able to control it. What they do is they pervert it so much to the extent that it's not decentralized. It's not censorship resistant or government resistant. Doesn't have mining. Doesn't even have proof of stake. Doesn't have any of these different type of consensus algorithms. It's completely a centralized scam under a false equivalence to Bitcoin using technology. The answer will probably lead you to the conclusion that it is not really a blockchain. Okay, number 7. I'm going to see if there's any comments here. All right, next one. Physical objects cannot be represented on a blockchain due to the dual consensus problem. So I was the first one to say this term, dual consensus problem. I was also the first to say the bootstrapping problem, which is kind of what I'm walking through here a little bit, but mainly these ones. Blockchain is extremely hard, and perverse incentives. Okay. But the dual consensus problem, one of the most popular claims about blockchains today is that they can be used as a ledger for tokens that represent some physical object. And you see this with NFTs as well. Like, hey, this token represents this piece of art when it doesn't. It's just a string of numbers. Your ownership of a physical object. An example would be a digital token representing gold in some vault somewhere. This particular variety of claim has apparently not been refuted adequately anywhere else, perhaps because working proof of concepts have made it difficult. So they proof of concept, they have some simulation where this works. And at the time, 2016 was before the big rush of all these NFTs and stuff. These proof of concepts work in very controlled environments where nothing is really going wrong, but have little hope of working in the wild. It's likely that all of the digital physical blockchain schemes will fail because they depend on what I call a dual consensus. One source of consensus is the physical world. The other source of consensus is proof of work. What happens if they get out of sync? It's similar to having two blockchains on the same network simultaneously, both fighting over the same tokens. One using SHA-256 and one using script, for example. Two unique consensuses emerge. Which one do you trust? What if they say different things? If the network or an account gets hacked and the digital tokens move, or the private key is lost, but the physical object is not lost, there's a consensus problem. The blockchain will say the object belongs to one person, yet the physical item may be in the possession of another person. There is also a problem with the object ceasing to exist. Like, say, you are tracking freight containers on ships. That was a big thing. Back at this time, there was a bunch of projects that were tracking all these freight containers, saying that they were going to track all these tokens on the blockchain and stuff. It's just ridiculous. Because what if the ship sinks or it's hijacked by pirates? Or say you register your home ownership on a blockchain, but it burns down. Anytime there is a discrepancy between the physical object and the digital token, you must have a centralized scheme to fix it. Therefore, all digital physical blockchain schemes will fail to scale and remain stable and fail to remain stable. Okay, so that's that. That's interesting. You guys, it's under bitcoinandmarkets.com/blockchain rules of thumb if you want to check that out. Okay, let's go back to the current thing. Kind of got way off topic. That was the layer 2 discussion there at the end. I'm going to check comments here. John Delaney is back with us. What's up? Just got in, going to listen from the start. This one is bound to be a good one. Yeah, because it's long, man. I try to make these short and it just keeps getting longer. So lightning capacity going up might be because of Alibi Hub. Is that how you say it? Don't know. I haven't read anything about that. That's possible. Very possible. 255 people watching. Jump over to YouTube and Rumble. Like, comment, subscribe. I appreciate you guys over there. Let's check Telegram, see if there's any comments. No different comments from you guys. All right. Well, I am going to sign off for the day then, guys. Thanks for joining me. Ansel Linder, Bitcoin and Markets. Check out my Forbes stuff. Follow me on Twitter. You get all my content if you follow me on Twitter or follow me on bitcoinandmarkets.com. So I appreciate you guys hanging out today. I hope you had a good start to your week and a very productive week ahead. And I'll see you guys on the next one. Bye.